Hello, this is Joe Hoyle at the University of Richmond, where I'm on the faculty of the accounting department, where I teach financial accounting, and of course I've written the financial accounting textbook that you're currently using. This chapter is about the reporting of property and equipment, land, building, and equipment. Most businesses have quite a bit of buildings, equipment, machinery, furniture, land, and the like. They spend a lot of money for this. The question is, how do you report this? In the first video problem, your roommate has asked about a building that her parents bought for one of their ice cream stores. They spent a lot of money. How do they report that? And they bought it and it has actually gone up in value. What do you do in that case? So our issues here are a couple. One first is, if you buy a building, if you buy equipment, and the value goes up, what do you do? And the answer is, in financial accounting, under the rules of US GAAP, you do not worry about increases in value in a building. And the reason is easy. You didn't buy it to sell, you bought it to use. So therefore, if you're not going to sell the building, the equipment, or whatever, does the value make much difference today in the operations? You're interested in the ice cream store. You're not interested in what if I could sell that building. You want to know how well it does in creating ice cream sales. So you've got the question of the value. If you're not going to sell it, an increase in fair value is probably ignored. There's another reason that fair value is ignored. Accountants love objective information. They like numbers that they can prove. Fair value is an estimation. It's an estimation that changes all of the time. You could have 10 experts come up with 10 different fair values, and you wouldn't know which one was the correct fair value. So if the fair value increases, the accountant ignores that. Now, as we learn in this chapter later, if there's some kind of an impairment of that value, it's damaged or it simply won't work like we anticipated, then accounting is conservative and it will recognize that. But increases in fair value, at least in US GAAP, are not recorded. Well, the next question then is, if you're not going to record those increases in value, what are you going to record? Well, if you think about it, a building or equipment starts out as a future value. It's going to help you to generate revenue in the future. You have a building, you have an ice cream shop, that will help you to sell ice cream. But as time goes by, that future value becomes a past value. So in accounting, what we tend to spend our time on is how do we go from a future value, an asset, to a past value, an expense. And that process is referred to as depreciation. So we're going to record a depreciation expense every year during the usage. This is another example of the matching principle, because the expense is being recognized in the same period that that building is used to generate revenue, used to sell ice cream. How do you compute this depreciation? You can compute depreciation on any method that's both logical and systematic. In other words, it makes sense. Now, the way that we usually do this is straight line. But we could also use an accelerated depreciation method, such as double declining balance. All these do is to determine how much of that future value we move to past value every year. What's the number we're going to use? And that's a computation that if you're going to learn financial accounting, you should be aware of. What we do in straight line method is easy. We take the cost, you spend $500,000 or $1.2 million on the building, and we subtract out what we anticipate as the residual value of that property when we finally get through generating revenues. So perhaps you buy it for $1 million, but when it's finished, it will be worth $100,000. The difference is what we refer to as the depreciable value. If I buy it for $1 million and I can sell it for $100,000 when I give up on it or when I get ready to sell it, the depreciable value is the $900,000 difference. In straight line depreciation, you simply take that $900,000 and you allocate it evenly over the years. So that if it's 10 years, the expense would be $90,000 per year. Depreciation expense $90,000 the first year, depreciation expense $90,000 the second year, and so on. Why do we do that? The easy answer is the future value of the property is becoming a past value, and we mirror that through that depreciation entry. What is the depreciation adjusting entry? If the depreciation is $90,000, at the end of every full year, we will debit depreciation expense for $90,000 and credit accumulated depreciation for $90,000. Notice we do not reduce the asset directly. We don't reduce the building directly. And the reason is the building isn't getting smaller. All we're doing is some of the cost is being moved from asset to expense. So the accumulated depreciation serves as a contra account to show that that movement has occurred. So after the first year, depreciation expense is $90,000. That's on the income statement. And on the balance sheet, the building is $1 million, and the accumulated depreciation is $90,000, and the net book value is $910,000. So you have the income statement report and the balance sheet. At the end of the second year, you make the same adjusting entry. Debit depreciation expense for $90,000, credit accumulated depreciation for $90,000. What's on the financial statements for that second year? Depreciation expense is $90,000 because that's the amount of expense that you're allocating to that year. $90,000 to the first year and $90,000 to the second year. How much is the accumulated depreciation? Well, that account keeps up with the total amount that you've expensed. So at the end of the second year, the accumulated depreciation will be $180,000. The cost is $1 million, the accumulated depreciation is $180,000, and the net book value is $820,000. And you'll do the same process under the straight line method for all 10 years. $90,000, $90,000, $90,000. And after 10 years, the net book value will be reduced to $100,000. Why? Because that's the expected residual value. The process for taking the future value and turning it into a past value. Now there are other methods besides straight line. They're typically accelerated depreciation methods, which means that they recognize more expense in the first couple of years and less expense in the last couple. I sometimes refer to those as ski slope methods because they're kind of slanted like a ski slope. High depreciation the first couple of years, much lower in the last couple of years. What's the theoretical justification for an accelerated depreciation? Well, the idea here is that more of the revenue can be generated early when the asset is new. So that if you're really trying to match the expense with the revenue, and there's more revenue in the first couple of years and less revenue in the last couple of years, then logically it only makes sense to have higher expense the first couple of years and less the last couple. Do many companies use accelerated depreciation? No, it's more work. The theory is not worth the extra work in that case. But do be aware that when you're doing your income taxes, an entirely different system is used. This is purely for financial reporting, either straight line depreciation or accelerated depreciation. So do you recognize increases in value? No. You're not trying to sell the asset. You don't like the number because it's not objective, and accountants tend to be conservative. So what they do is they take that asset and they allocate the cost to expense over that life. And how do they do that? Through the recognition of depreciation. This is Joe Hoyle. This is the University of Richmond. This is financial accounting. We're looking at the accounting for property and equipment. And that topic always involves the recognition of depreciation expense. Work hard. It's worth the effort. Take care.